The next thing that we're going to look at is accounts payable, so payments to suppliers. And payments to suppliers, we go down and we have 87,810, and we close up with 103,960. Now that, something has to be going on there, because we can't just, through nothing happening, owe more on our accounts payable. Like, something's got to go on, has to have gone on there. So the things that we're interested in that affect accounts payable in this situation are going to be sales and admin expense and inventory. Because those are the things that we will owe people. So we've kind of collapsed payment to suppliers into not only payments to suppliers in terms of inventory, but also payment to suppliers in terms of services, so wages, like all of those other things. Now in this case, you got told a couple of pieces of information. You got told sales and admin expense was item 5 was 47,630. So we debit 47,630 and we credit accounts payable 47,630. Now again, that could have all been a cash payment, but it is easier just to put it all in as a payable and then we wrap it up at the end. Now, if you put it all as a cash payable, I'd urge you to just play around with that at home. You'll see that it actually doesn't affect what you do. But it is easy just to assume it does go through the payables section. Now, that's payables. We also get told cost of goods sold. If you go to item 7, cost of goods sold was $50,000. Now, is cost of goods sold going to be credited to accounts payable? So we debit cost of goods sold. So when we sell inventory, we debit cost of goods sold, what would we credit? Oh, we debited the expense. So cost of goods sold is kind of the sort of pseudo expense item. But what's the other side of that transaction? Is it? You're decreasing, yeah, but what asset are we decreasing? Yeah, inventory asset. Cost of goods sold, we're getting rid of inventory. So we're not actually, this isn't going here. Because you may have purchased all of those last year. You may have paid for them all last year. You may have not paid for any of them. You may have got them on credit and then paying next year. So we've actually got to incorporate the inventory asset, and inventory starts at 90. Ends up with 95. You guys had John Tyler for first year, right? Did he cover inventory? Cookie jar? Yeah, it's cookie jar. So we start at 90, we end at 95. We got rid of 50. That means we had, if we just have this and have this, that means we should end up, if we didn't buy anything, we should have ended up with $40,000 as a closing balance. We didn't end up with that. We ended up with 95, which means how much inventory got brought in this year? 55,000. Bang on. Thank you. So we end up with $55,000 being the purchase. So debit inventory $55,000, credit accounts payable $55,000. Because that is us going out to the hardware store, or going, I don't know, assuming this is inventory from the hardware store, going out to whatever our suppliers are and getting $55,000 worth of inventory and including that on accounts payable. Now, we see all of this, 87, 47, 55, you know, that would equal roughly 100 plus that, so that's roughly 180 odd. Ballpark. Definitely doesn't equal 103. The difference is how much we paid. And so when you add all that up, and again, urge you to do that, hopefully I've written them all in right. I'll ignore the calculator. I mean, I know you guys weren't at the day lecture, but I was having massive problems actually using the calculator. It's getting wrong numbers all over the place. But what we should end up with is, if that's done correctly, is a debit $86,750, because that is what you actually paid to your suppliers. And that will be a credit to cash of $86,750. And I realize I've stuffed up there, because cash, when it's late in the semester and it's late in the day, these things happen. Cash had an opening balance of $100,000. So that should have been in there, and I apologize for that. So we do all of that. So we deal with the COGS account, sales and admin, accounts payable, inventory account, and what we end up with is $86,750, which is what we have down here. Everyone still with me at this point? Kind of, hopefully. Again, all of this, it won't be immediate, but all of this in some way, shape or form will go up on video at some point in time. So be aware of that. The last two, interest and tax, are actually fairly straightforward in this example. The first one, interest expense, and the second one, tax expense. And I'm just going to flick back to the information that we have. And actually, while we're here, let's tick a few things off. We have dealt with item 5, so that's gone. We've dealt with cost of goods sold, so item 7 we can get rid of. And we've dealt with item 8, so sales totaled that much. So we can get rid of those things. What you're trying to do with this is trying to look at all the information that you have about a particular item and seeing and using whatever is there. So we have additional information sitting here of income tax. We have income tax declared, which is probably not quite the right word, but income tax declared and paid during the year was $5,000. Now, what other accounts in the balance sheet could be related to income tax? There are 3 of them. We only did it last week, so it should. With tax. There are 3 tax-related assets or liabilities. Not account payable. There's just 3. We talked about it last week. No, not depreciation. It's about tax. It's got the word tax in it. There are 3 accounts with the word tax in it. They're deferred tax assets, deferred tax liabilities, and what's the other one? Yeah, so, no, not expense. What's sort of in relation? What do you owe? If you owe the government right now, you have a current tax liability. So it's kind of a tax payable in relation to what you owe the government, and a deferred tax asset, deferred tax liability. Have a look just for anything with the word tax in it. Do you see anything with the word tax in the asset section? No. Do you see anything with the word tax in the liability section? No. That's sweet. That means the only thing we have to worry about is this particular item here, and that's even easy because it tells you it was paid. And that usually means cash money. So we have a payment of $5,000. We also assume that should be income tax expense, but you get the point. That the tax paid, if you imagine the tax expense, we would have $5,000 of tax expense. If you wanted to have, look, for absolute completeness, current tax liability, we would put $5,000 there because they owe $5,000. There is a 0 balance to start with, so I didn't put anything, but there is a 0 balance at the end. So we need to have an amount happening on that side, and that is what comes up in terms of cash. So that's your tax amount because it's just being paid. Realistically, you know it was paid, so we don't need to do this process. And you could literally just go tax paid negative $5,000, but again, while it's starting out, good to be systematic about it. Tick. Interest expense, much the same deal. Do we have any interest receivable? Nope. Do we have any interest payable? Nope. There's nothing we need to worry about there. Because even if there was an amount, it would be 0 balanced. So I'm not even going to go through a payable account. We had $20,000, which was interest expense, all paid, $20,000. 20,000, 20,000, and interest paid 20,000. So I'll just expand that out for a moment. Look, realistically, the expense accounts, the sales and admin expense account, the cost of goods sold account, the sales revenue account, you really don't need to do, but just for completeness and getting on top of all of this, it is useful to put them all in until you're comfortable. Done all of that, add them up, we end up with 154,950, and we're done with cash flow from operations.